Welcome to another edition of the Cross Country Super Podcasts. And joining me, as usual, is Jemma Sanderson from Cooper Partners, all the way in Perth. And I'm Darin Tyson-Chan, of course. Hi, Jemma. How are you?
I am good, thanks, Darin. How are you?
That's good. I'm pretty well, thanks, and lovely to see you as usual. And today we will be discussing another hot topic, and that is the non-arm's length income, non-arm's length expenditure rules.
Very exciting.
How contentious have these been? And you must have been hiding under a rock, as I usually say, if you're totally oblivious to this subject, because God has been dominating discussion since 2018.
Yep.
And you may well ask, how hasn't it been resolved in that period of time? But believe it or not, it has been going for that long. And of course, that in itself is indicative of how contentious the whole concept has been. But probably, look, Jemma, let's start with one of the more contentious issues of the non-arm's length expenditure, or NALE with an E, aspects, and that was the general expenses provisions, which really did get people running scared because there was a potential for the whole fund's income to be taxed at the highest marginal tax rate. What are your opinions of that?
Well, it's interesting. When all these rules came out in terms of the changes in effective 1 July 18, and then when the tax office released their practical compliance guideline on the general expenses, I think that was quite surprising for the industry at the time. And like you said, it still hasn't been resolved, and that is a phenomenal consideration given that nearly 6 years ago that came out. Anyway, we proceed forward. So with the general expenses, and I'll start off by saying for me, that was, yes, there was the concern that all of the income of the fund could be tainted by not charging a market rate for those sorts of general expenses. And my view on those sorts of things at the time was, well, most of the issues with that in a self-managed fund were things like accounting fees, audit, actuarial, and investment management fees. They're not enormous items. It's not, hundreds of thousands of dollars or anything like that. The easiest way to manage it is to charge an appropriate fee for it. And the tax office did come out and talk about having policies in firms and things like that, and that excuse me, managing all of that. Then with the issues coming about, originally consultation was that 5 times the non-arm's length expense that should have been charged, or the difference between what was charged and what should have been charged, that would be taxed at the highest rate. And that was in the consultation. And then we had some draft legislation come out where that got moved down to 2 times. So it's interesting that it was the whole income of the fund could be caught to down to 2 times what the difference is what is taxed at the highest rate. So we've gone full circle back to almost, it's a bit like a bit of a nothing almost now. The challenge still remains in, well, what is arm's length? And so what is even that gap? So if you have a look at the LCR back in the day, the tax office said, compliance resources will be put, if people can demonstrate that they've taken a reasonable approach, then again, that's all fine. And really it's going to come down to the auditors picking it up and saying, show us the reasonable approach from that perspective. So I feel like we've gone almost full circle back to it's just a bit of a nothing. I know it's not a nothing, but in the scheme of other fish to fry in the SMSF space, that general expense non-arms NALE is just less of a concern from that perspective. Now, I know that the draft legislation went to the Senate committee in more recent times. All the professional bodies advocated for it being entirely removed, and because it doesn't apply to APRA funds, so it should then also not apply to SMSFs because of just the nature of the expenses, the way that has been put in place. background in the nominal or nil interest LRBAs from related parties. That sort of was the catalyst for this sort of coming through. But there's other mechanisms in place that capture that, so we don't really need it. That those sorts of messages came across from the industry, and the joint all the joint accounting bodies did joint submission to Treasury on that. But it seems that those changes have been accepted by the Senate committee. So all of that advocating and appearance at the meeting was to no avail. So we're sort of trapped from that perspective. So the consideration remains the LCR that the tax office had out, 2021/1, I believe it was, or 21/2, that and I use this term, kicked the can down the road. So allowed, you didn't have to address it until it was to 1 July 2022. So now whether we need to continue to kick that can down the road until this legislation finally passes, or we've got that certainty purely from the tax office's perspective. So the legislation says that it won't apply to expenses prior to 1 July 18, that from that general perspective, and it has that retrospective impact, so that it is that 2 times, so that people between 1 July 18 and now aren't caught by how the previous provisions were drafted with this amendment coming through. So anyway, that's sort of, I feel like, where we're at with general expenses, a bit full circle back to the 2 times, but waiting for the legislation to pass and then see how the tax office's approach might be to that, depending on which quarter that actually passes through.
In saying all of that, Jemma, you raised numerous good points, or further discussion points about this whole subject. You did mention, auditors picking this up. And I know a lot of them are a little bit concerned about more and more onus being on them to be able to look at stuff within a fund to see whether or not it's complying. Do you think that's a legitimate concern of theirs? I know in the example that the ATO has put out, a lot of people refer to is it example number 7 or is it number 9? The Trang, the plumber.
Oh, the plumber. Yeah.
Yeah. So that is being referred to a lot in the discussions over NALI with an E. And a lot of comments I hear about that is, well, how would an auditor even know what a trustee does? Like they're not there necessarily to monitor every single day of, did you do something to the property that's held within your self-managed super? Like, how would they even know that? But in a lot of ways, as you just mentioned, they're a little bit on the hook for it, because it's like, oh, well, they should be able to review it and they should potentially be able to pick these things up and everything will work fine after that. But is that realistic? I don't know.
Well, it's really, I feel like poor auditors get thrown under the bus a bit, and they're the ones holding the baby at the end. You only have to see some of those cases that have come through, and even the Melissa Caddick stuff. And I know that that's not the topic of this particular discussion. However, it's one of those things, the auditor they're a bit of a gatekeeper to, making sure everything's okay before it goes to the tax office. But really, the tax agent should be the one that is picking this up when they prepare the financials and the SMSF annual return. Now, I know a lot of trustees out there do it themselves, where they might be accountants and they've got the capability or the know-how to do that. But mostly SMSFs will have a tax agent involved that is preparing the financial statements and the annual return. So the expectation, this is a self-assessment thing, the expectation, and then the auditor is checking off on that and making sure it goes through. So it's one of those things where it's an awareness education piece on all of this as well. So you don't want a small thing like that tainting the income. At least now, at worst, if Tran goes and fixes the tap and charges nothing, and it would really be $500 that, although that's a bit of an anomaly, that particular example is asset specific, so it sort of isn't under the general. But if Jemma does the financials, or Gemma's firm does the financials and annual return for her fund and doesn't charge, and the usual charge would be $4,000, then it's really $8,000 taxed at 45%. If Gemma's firm doesn't charge, that's really, it's not sheep stations in the context. It's not the whole income of the fund or anything like that. So it's, I don't know. It's just, I feel I don't want to be flippant about it, but I've almost moved on from that, and I have more concerns about the asset-specific expenses to come from that. And also, there was a tax determination that came out in August last year about the treatment of non-arm's length capital gains and how the calculation of that happens from the ATO. And like that, I've got more of a concern about how that might operate, and the asset-specific expenses and the general expenses. Again, I don't want to sound flippant and that I don't care about general expenses anymore, but where we've landed on it, it's not the apocalypse like it was, with all expenses potentially being caught if you don't charge an arm's length fee on accounting fees or legal fees, because the trustees and because it's on non-arm's length arrangements, it is so we've a position has been landed on. Is it perfect? No, it's not, but it's the asset specific stuff that I have much more of a concern about.
Yeah, in discussions with Peter Burgess about this from the SMSF Association, when this sort of proposal came out, he had a very interesting take, I thought, on it, whereby he was almost arguing that materiality would come into it.
Yeah.
So if you're talking about, obviously, depending on the amount that's involved, and I'm not a technical specialist, but he was talking about it being picked up in Part A of the audit as opposed to Part B of the audit, which is obviously taken a little bit more seriously from the ATO perspective. Yeah. He actually said that the ATO itself has admitted that we're not really interested in the Part A stuff. Mm. So if it gets captured from that perspective and it's immaterial, they themselves aren't even that concerned about it. So perhaps we've landed at a spot where that's it. Let's just move on. Let's stop talking about it. It is what it is, and let's move forward. Now, I should qualify that in saying that the ATO said they're not concerned about it per se from an isolated issue perspective. But they did say that if you get caught with any other compliance issues, then if there's an issue there, that will get picked up as well.
Oh yeah, definitely.
So
again,
in isolation,
back to materiality.
Yeah, exactly. Yeah. So in isolation, they're not concerned about it. Obviously, if you have other compliance issues, that will probably go into the fold of how they treat it. But at the end of the day, I think Peter makes a good point, and maybe we should move on now. I don't know whether or not the industry is disciplined enough to stop talking about it. I know we're talking about it now, but we're not actually talking about it in perpetuity, if that makes any sense at all. But I think it'll be interesting to see whether or not the industry is actually disciplined enough to stop talking about this and move on, because maybe we've landed at the best possible solution. As you said, it's not perfect, but maybe it's the best possible solution, and we should just accept it, and that's it.
Well, the other thing, I'm back to that materiality, is if a fee is charged, let's say, if nothing's charged, then obviously that's a different scenario because nothing has been charged. But if a fee is charged and then that's at a substantial discount to what would have been charged, but how do you determine what would have been charged? That's the gap that is subject to this 2 times. Like I said, if it's 0, then it's a bit of a a more difficult argument if you end up in that arena. But if you did charge a fee and it wasn't $1 or $50 or whatever it might be, it was a few $1,000s. There are firms out there that administration firms that are charging those sorts of those sorts of things. So what are you comparing it to? Now, you would be comparing it to the firm who did it. What would that firm have charged if you were a standard client? But you have to demonstrate, is that reasonable, and all those sorts of things. So anyway, we've like I said, we've gone full circle, and now we are at that materiality sort of realm, and we just move on. I think we should just move on, to be perfectly honest.
You raise a really good point there, because I still remember when the non-arm's length expenditure provisions dropped and they said that they were potentially going to implement this. Dana Fleming was still the person that we were dealing with at the ATO. And she was asked a question. I thought it was a pretty good question. If I can put my accounting hat on, which I don't do very much these days anymore. She was asked a question about that. How do we know what's indicative? And a comparison was actually made to the FBT rules. And I don't know whether or not this still exists, but certainly when I was an accountant, it did. So whether or not you got charged FBT on car parking depended upon how much a parking station within a 5 kilometre radius would charge for all day parking. And if it was in a certain band, then it wasn't worth, I think it wasn't worth charging FBT for, or the FBT would be negligible. Versus, obviously, if you got parking underneath your building in the CBD where parking is really expensive, then of course there would be a substantial FBT charge. So I thought that was a great question in terms of, well, how do we actually measure this? Like, we need some parameters to be able to measure this. And I thought her answer was really good. She goes, look, we're not going to go down the path of assessing expenses around a location or a geographical set of circumstances where, I don't know, H&R Block in the suburbs might charge less than H&R Block in the city. She said that's massively too complicated. It's not a rabbit hole that we're looking to head down. And it's funny, even though, as we both agree, we've probably come to the solution that it's going to be landed on, but that aspect of it is still a little bit contentious.
And also, I think the fees that are charged to funds, I know that there's certain admin firms out there that has their fixed fees that they charge, but a lot of accounting firms, their fees are based on the time it takes. So what you might charge not very much to a fund that's got a couple of term deposits or whatever the investment strategy has been decided on, and it's quite straightforward, versus the fund that is worth a lot, has like hundreds and hundreds of transactions, and maybe a vast array of investments in it. That's going to cost a lot more in time than to process it and deal with any of the other compliance issues and making sure that that's all schmick to go to audit, as opposed to the smaller one. So again, it's all circumstantial at the time what that arm's length fee might be. So it's always that sort of consideration coming through.
Now, one of the other
things, again, we're not helping it because we're talking about it continually.
Yes, we are talking about it. But as far as this podcast goes, this will be potentially the last time we talk about it.
Oh, that'd be
a win. You raised another really good point, Jemma, and this has been raised by other people within presentations that I've been to recently, and that is this. It's not confusion, but I suppose you could call it a misnomer, that the focus has been so heavily on this general expense stuff that people have almost thought that, this amnesty or this not doing anything about it applies to the specific asset non-arm's length expenditure provisions. And of course, it didn't. I mean, they've been valid for that whole time. And obviously, potentially, people have been getting into trouble because they've been under the misconception that, I don't have to worry about that. Like, it's still being fought out. That's not an issue for me. um, you know, has the absolute focus on this actually created another problem in another area that obviously unintended consequence, but it's happened and it's happening. I mean, you've got direct anecdotal evidence by the sounds of it that it has caused a bit of an issue.
Well, I mean, that's always sort of been the concern, and that, you know, that I'll use my terminology again, the can has been kicked down the road on asset specific expenses. Now, things like Tran doing the plumbing consideration, and back to your point of, well, how's the auditor going to know? Sure, there's that consideration there. If a tree falls in the woods and no one hears it. So is that the right analogy? Anyway, we move on. But it's, for me, the biggest concern, well, there's a couple. One is the acquisition of an asset. So, and was that on arm's length terms? So that approach, and that's continued to be a consideration and an issue prior to 1 July 18, and particularly when you sell it and there's a gain, and also subsequent to 1 July 18, it's been, a lot more robust around that. So the consideration there being, well, it doesn't apply to income earned prior to 1 July 18. However, if income from then is still captured. So if you bought the asset prior to 1 July 18, so say you bought units in a unit trust, it's an unrelated but closely held one, you invested in a property back then, and that's all been fine, and then you reinvested each year the distribution, but that was always done at $1. So that the acquisition of the initial units would be fine at $1 because you haven't acquired the underlying asset. But then every subsequent year, if you acquired those units at $1 each time, that's highly unlikely to be the market value of the units in that unit trust each year. So you've acquired them, it might not have even been at market value, at a discount, because depending on what the underlying assets were and all that usual sort of stuff, what's the market value of that unit trust investment each time you reinvested? So like, that's a real concern. Say that happened and had happened constantly over a period of time since acquisition, and then you sell it, or you sell an asset, one of the underlying assets in that trust in the current financial year, because you haven't acquired a lot of those units along the way at market value, that is tainted. Not only that, if you haven't acquired those over that period of time, and it's that proportion of units with the distribution each year is also caught because you haven't acquired them for market value. So there's that, I feel like is a real concern, I have to say, from that perspective. And the changes that were released recently, there was a comment made in there that it wouldn't apply to expenses incurred or not incurred prior to 1 July 18, but it is, there's no real clarification. For me, that is implied that it's about general expenses. It's not any of those specific expenses or acquisitions, because if you read the explanatory memorandum, it's all, again, about general expenses and not asset specific. So I've got a real concern on that. From that perspective, there could be a whole raft of funds, because the legislation and, well, the explanatory memorandum also just talks about the asset specific expenses provisions are unchanged. So that has been in place. The other so that's with the acquisition of the asset. The other thing that we also encounter is, so I'll use my closely held trust as an example, is, say it was doing a property development or the like, and one of the investors is managed the project, and that's what they do for a crust. So they're property developers with out there in the usual realm, and they didn't charge a market rate fee for project managing that. All of a sudden, that income in that year is then exposed. So it's, it has that carry-on effect from that perspective with the asset-specific expenses, and I've got a much more of a substantial concern about that from that perspective.
Yeah, if you get tripped up by those rules too, there's no rectification, is there? Once once it's done, and it's done in perpetuity, and
Absolutely.
until you get rid of the asset.
Yep. So
Um,
that whole property, so if you were the project manager and you didn't
yeah,
charge, that would
yeah.
just fall in that year. But if at acquisition you haven't acquired it for market value, then that's not just the capital gain at the end. That's every year that income, any income generated and distributed, is you've got NALI exposure there. So that's definitely more of a concern for me, I have to say.
Well, that's an extremely severe penalty.
Mm.
Um, it doesn't matter how you look at it, it is an extremely severe penalty, and it almost would encourage you. Well, I don't know, as a mitigation exercise, maybe to get rid of the asset sooner rather than later. Obviously, if it's a successful asset and it appreciates, like we all would like our assets to, the more it appreciates, the worse you're going to be with the capital gain when you eventually sell it. So if you get tripped up by it, it's almost pushing you towards, well, if I have to mitigate this risk, I better get rid of it as soon as possible.
But that in itself can be a real challenge because let's say, so how do you get rid of it? You've got to sell it. If you've got partners outside, so, it's a closely held trust, how easy is it for you to perhaps dispose of your interest in that trust to the other parties or to another related entity, those sorts of things? Because that, like, if you don't have if you're not eligible to say maybe receive that out as a lump sum payment because you haven't satisfied a condition of release, then you've got to come up with the money external to super to perhaps buy that out. If you can't sell it externally, what does the unit holders agreement say? Is if all super funds are invested in that, everyone's got that same sort of risk profile that they need to have a look at. So then, it can, and I don't like scaremongering, but it certainly is an area that we're seeing more and more when, we pick up some files and we're like, oh, that's a concern. Well, not only that reinvestment hasn't occurred at market along the way, we've also seen situations where the expectation was that a unit trust was not an in-house asset, and it actually was. So it's just been ticking over for a number of years in breach of the in-house assets test, and that's not what we're talking about here. So those unit trusts, closely held unit trusts in self-managed funds, is a real area of of compliance risk if it's not done properly, and particularly on this. And the non-arm's length side of things is particularly, prohibitive if you get it wrong. And like you said, how do we resolve it? Do we, especially if the acquisition is the issue, if it was 1 year on that, tran sort of expense or that property management side of things, then you can just carry on subsequent years and be okay. But if the original acquisition wasn't undertaken at market, then you've got that ongoing risk. But then practically getting out of it can be a real challenge.
So it's funny because it's not really funny, but it presents a strange situation. If you're in that predicament, you're almost thinking to yourself, you're having to weigh up. I mean, if the circumstances are in that closed unit trust that you're talking about, if you've got circumstances like that, you're almost having to weigh up which is the two lesser of two evils.
Two evils, yep.
Basically, well, gosh, it's going to be so difficult to try and unwind this. How do we even go about it? How do I even start? What sort of strategy can I put together to try and do that? Oh my God, it's so complicated. I don't even know whether or not I can do it versus I'm going to have to pay a massive amount of tax when the capital gain comes in. But is it less painful to actually do that than to try and rectify it? Now,
But you
I don't know how
can't, but
I
you
don't
pay
know
the
how
tax
you
anyway, because you're going to
yeah.
pay that tax, now,
Well,
where it might be less than later if you if you keep it. So anyway, it's always like that predicament, and sometimes you can resolve it if in terms of perhaps moving the asset up to the super fund from the unit trust if it's eligible from that. So there's plenty of things to have a look at. It's unhelpfully, it depends on the situation and the circumstances. The easiest and most cost-effective way to resolve those issues. So again, that's a challenge that we're certainly seeing, and that's just on the expense side of things. The other consideration is that's on the basis that the fund has a fixed entitlement to the income of the trust. So if they don't have a fixed entitlement, which is another thing, we're looking at a lot of historical trust deeds, and they've got the fact that there's discretionary. The trustee can exercise discretion on various distributions. So all of a sudden, we've got this issue with fixed entitlement. So we're automatically in before we've even considered the other, the expenses and if they've been incurred on an arm's length basis or not. So that whole operation of the non-arm's length income provisions, a lot of people have been alive to it for a number of years, but given this general expense being kicked down the road substantially since these changed rules came in, I think a lot of people have not necessarily given due consideration to all these other issues that have come through. So that, like I said, that is far more of a concern for me with the NALI and NALI with an E, NALI with an I, both of those, than the general expense side of things.
So, sort of extending that concept, I know that earlier we both said that we should stop talking about the non-arm's length expenditure, general expenses side of things, because we've landed in a situation which I don't think is going to improve, and it's not going to go away. But should the discussion around NALI with an I and NALI with an E be on this now?
Yes,
Should
absolutely.
the industry be disciplined enough to be able to say, all right, well, let's pivot now. We're still not happy with some of the aspects of these rules as a whole. Let's see what can be done about this. Because obviously, as you said, any discussion around this has just been pushed to one side because the concerns over particularly the general expense provisions were that catastrophic that it's just dominated everything to do with that. And yeah, should we all start talking about this now and try and come up with a better solution to what's going on now? Because I don't think anybody who's fair-minded would think that this is a great situation. And I don't even, maybe I'm a little bit naive, I don't even believe that it's necessarily what the ATO wants. Like, I don't necessarily think these are the outcomes the ATO would like to see. It's just a matter of, well, these bits and pieces are falling out the further we go along the path. And of course, you can always improve things. You can always have the discussion as to how can we make this better? How can we make it less severe for or I don't think anybody's complaining about, if you've got a compliance breach, you need to in some way potentially pay a penalty, as long as the penalty is commensurate with what you've done. And if you're willing to rectify, what happens if I didn't actually realize it? Okay, I'll fix it. I don't want to be in compliance breach. In situations like that, surely some sort of leniency or reasonable approach would be better for everybody. Not just, and obviously I'm not talking about the bad actors out there who are trying to gain an advantage. There's always going to be those around, but surely you can't beat everybody with as big a stick as you'd like to beat those people with, just in general terms, because I don't think that does anybody any good at all.
Well, the general expenses thing really came to the fore and was on the tip of everyone's tongue and really concerning, because it wasn't just SMSFs that it impacted every single superannuation member in the country. So that's the $1 trillion+ in super that it could impact. So, that's definitely why it was, a concern and out there. So with this asset specific side of things, I agree. I'm certainly of the view that it wasn't intended to potentially be that harsh in the way that all went through. But at the same time, there's the consideration of, well, it's an integrity measure in there to stop people from diverting assets into super and getting that tax concessional treatment. So we really need to be careful to make sure that we're not, those people. Again, the penalty, if there is a penalty, needs to be commensurate with what it was. And a lot of this stuff is inadvertent. So I'm talking there about the situation. I'll go back to my unit trust where you've got three owners of it. Everyone's reinvested their distributions each year. So it's the dollar amount has been reinvested, but equally by everyone. So it's still the same proportions. It's just not at market value. So it's just the outcome would be the same if you did it at $1 in terms of the proportion ownership, whereas if you did it at not $1, if that makes sense. So, in that case, it's just inadvertent, and the outcome, if you'd done it properly, and I'm not saying that people shouldn't do things properly, because they absolutely, that's what the legislation is there for. But, in those sorts of situations, you would think that there might be a concessional thing available. But I guess the other thing is, because people haven't been alive to this, they've missed it, and it's gone through to the keeper, to use a cricket analogy, or kicked into touch if you prefer rugby, or whatever that looks like. So they weren't the droids we were looking for. I've got to get my Star Wars reference in there. No. So, that it hasn't been looked at by, because people weren't aware of it or even thinking about it. So it's sort of carried on, hasn't been disclosed as non-arm's length income. So it might be that history is where it is. Amendment periods apply back. We've got the 4-year amendment period. If that operates from that perspective as well. So it might be that the tax office approach to that sort of thing is going forward. But the consideration with that still remains that if I sell an asset this financial year, and so maybe the income, the tainted income, because I didn't acquire it for market value back in 2005, or along the way, the capital gain is still caught. Even if they are sort of concessional or allow that, or it's outside the amendment period, that's what happens. So it doesn't change that situation, and what that looks like and how that practical approach might be, because I do see that there's probably a lot of funds out there that are not aware that this is an issue, and they're trapped and caught by it, and the ability to consider, actually we did issue an incorrect number of units, but that was back in 2008. So, that sort of thing. And even when we moved over with the transitional rules for pre-99 unit trusts between 99 and 2009, we're picking up a lot of those and seeing how that approach happened back then. And again, that wasn't done at market value at the time. Trying to rectify all of that, I mean, that's a real challenge in itself as well.
Yeah, I think you raise a really good point. I do want to qualify my comments around this, is that you're absolutely right. It's an integrity measure, and in no way, I think, are we saying that it should be softly either.
Absolutely.
I think
I did not interpret that's what your comments were either, Darin.
No, I think more than anything else, it actually highlights how difficult it is to get the balance right. I think that's basically what we're saying, is that the balance has to be right, where the penalty is not so severe that it's ridiculous, but then the penalty is not so soft that it doesn't discourage bad behavior on the part of whoever wants to try and get an advantage or an unfair advantage by using an SMSF. And of course, that's not what anybody wants, because we know how quickly people are to jump on any bad stories about this sector, and it's not what we want, and it's not what the system wants either. I don't think that's good for the system. So obviously, advocating for some sort of right balance is really what we need, and I think it needs to start with the discussion, as you say, Jemma. Let's park the general expenses thing. Let's concentrate on this, because this is going to have pretty significant impact. And it already is from what you're saying, but going down the track, it's going to be an even bigger problem for more people.
I know that at various conferences in the last few years, this has certainly been a topic that has been approached, looking at the NALI from that asset-specific perspective. But again, because that always played second fiddle to the general expense monster, perhaps people, again, just dismissed it as kicking the can down the road. So it's, that's something to have a look at. The other thing that may arise is whether the tax office allows, and I'll call it like an amnesty, or I don't remember if you remember Project Do It, Disclose Offshore Income Today. It was a great acronym. And that was allowing people to basically bring, if they taken money overseas and weren't disclosing it, it allowed them to bring it back to the country. They disclosed it, and then the tax office was just going to go over a 2-year period and not go back historically, which if you had, generally, they'd have the opportunity to go back historically outside that 4-year amendment period because of fraud and evasion and all that fun sort of stuff. So anyway, I digress a little bit. Whether there's maybe there's an amnesty put in place to allow things to be brought up to code, for want of a better phrase. When the practical compliance guideline came out in 2016, 2016/5, which was to do with the limited recourse borrowing arrangements from related parties, and all that benchmarking and that tax determination, I'm going to get this wrong, 2016, I think it was, testing my memory here. When those came out, it gave people the opportunity to basically rectify and get their arrangements, like I said, up to code. And then provided they did that before a particular period of time, then, and they continued to benchmark it, then they wouldn't fall within the NALI regime. So I don't know whether there's an opportunity to do that. It's very challenging to go back to 2005, if that's what my example is, and change what you paid for an investment. So, those things can be challenging, but, perhaps there's something that gets included in there. It might be an area that doesn't get picked up until the asset's ultimately sold, and then that ship might have sailed. So you're just still seeing what that looks like. But again, it is a challenge from that perspective to consider the approach and how that might work. But is it something that we need to be again, people are potentially unaware of those implications and the potential size of those, because they've just reinvested $1. It doesn't really matter. It doesn't, it's a unit trust that the fund owns, sure, but it's separate to the super fund, so it's not covered by those rules. But again, if you overlay all of that, it actually is covered, and you need to be really careful.
You actually raise a really good point about the amnesty, especially, and it's a really good example at the amnesty around the limited recourse borrowing arrangements and making sure that your affairs are working within the parameters of the safe harbour provisions that the ATO provided and that sort of thing, because and that's probably a very good example to use to argue that an amnesty would be good in this situation, because at the Tax Institute Superannuation National Conference, which we both went to in Melbourne recently, Paul Delahunty was talking about some of the experiences that the ATO was witnessing. And one of the points that he did raise was that adherence with those safe harbour rules has actually been really good. They don't actually see much of a concern around related party loans or anything like that, which has been captured by that practical compliance guideline. So maybe that's actually a really, really good basis to say that, well, it appears to have, what you're telling us, it appears to have worked really well in that instance. Why don't we try and apply it here, because it might be a really good outcome.
And I think, that whole, I think they use the term swim between the flags. And, this is where the tax office, they've been really good on that, the super front. I think, I remember back when I'll call it Simpler Super came out in 2007. I'm showing my age here. I remember when that came out, and there was just a raft of SMSF rulings, determinations, loads of ATO IDs that came out that were really, really helpful in terms of, and I think that was when Stuart Forsyth was like running things back then. He was like, right, we need to provide all of these sorts of things. Now, I know the way the ruling sort of system works is, it might not be binding on the commissioner for various bits and pieces, but when it's a contentious area or something like this, which I'm sure a lot of people have undertaken inadvertently, like they often they're not doing it, oh, well, we'll do it at $1 because we want to, divert income into the super fund. People, sure, there's people that might be going down that path, but a lot of them are just trying to get the most out of their investments and what they're doing for their super. And we love super because it's very tax effective. So but some of these things are inadvertent, so there's not that whole intention of going down that path. But with the tax office's guidelines and guidance on all these sorts of things is really helpful in the absence of getting a private ruling and then seeing what that interpretation might come out at. A lot of these, we're talking NALI, so that's a tax concept. So you can get a private ruling, but if it was to do with SIS, you can't actually apply for a private binding ruling. So you have to get SMSF specific advice, which isn't binding. So, all this, my point, which I will get to, is that the tax office's guidance is a great way for the industry to operate and swim between those flags, avoid any compliance issues. So if it is an area where perhaps the tax office can come out and show what those flags might look like, provide an amnesty period perhaps to resolve go within those flags, that might be of benefit. One of the budget announcements a couple of years ago was about resolving legacy pensions and to provide a 2-year period of time for people to do that. So again, that's a government proposal from a legislation perspective, but a 2-year amnesty, that Project Do It, I think, was a 2-year period of time to get it done. So whether there's that sort of arrangement, and like I said, with the LRBAs, there was a period of time to get things, and I'll use the term, up to code. So I don't know, and it's always hard with these sorts of things because it might be an opportunity for people to, again, get things up to scratch. And then the whole point is, and it's an integrity measure, these rules. So the people that might have intentionally been doing the wrong thing, they, get a bit of not a free pass, but the integrity measure, the application of that hasn't actually applied in the way it's been intended. Anyway, it's one of those. It's a real challenge because you've got that situation where no doubt plenty of people fall in inadvertently. However, that the rules are as they apply, and they could be applied very strictly from that perspective if the tax office looked at it, and it is self-assessment. So you've just got to have a look at that. Do you get then slugged with the tax if you haven't looked at it properly? Are there substantial penalties involved? All of that. Again, I don't want to scaremonger on that front, but it's, what does that look like? And again, everyone's going to have different circumstances and risk appetite from that perspective.
Now, Jemma, we're probably getting a little bit close to time, but I did want to raise one thing. It's a slight tangent. You mentioned it a little bit earlier, and I promise listeners and viewers this will probably be the last time we talk about the general expense thing. I'm still amazed that during the whole discussion period, and you alluded to before that it was a nuclear issue, I think at the time, because lo and behold, it looked like the industry funds were going to be caught by this, because potentially what happens if I offshore my admin, then I'm not necessarily paying the market rate that's considered the market rate in Australia. Will that be caught? There was a definite scare. I know there was, because Peter Burgess said that they were in talks with the APRA regulated funds about, look, we've got to all work together and get this resolved. And lo and behold, they got a carve out. Now, I'm just gobsmacked. This is another example of how this sector is being treated totally differently to everybody else. As per our last discussion, it was about the $3 million soft cap. And of course, we know that the simplistic way a yearly earnings is the correct word, is being calculated was all to do with, but their systems won't allow them to do that. So we can't go down to the individual member level. There are continual examples of this, and some of these are a discussion for another day. I will give a bit of a highlight about that. This whole retirement incomes discussion paper that came out right at the end of last year, I think is quite ridiculous. But we'll have a little bit more to say on that at another time. But it just continues. They get a carve out. Oh, but you blokes aren't off the hook. So you deal with it. Too bad.
Well, so I don't disagree with that as a general sentiment, I have to say. I think with this whole NALI thing, and I know that Peter Burgess brought it up in the Senate committee meeting, sort of acknowledging that the dealing with an arm's length, because the trustees of a super fund are the members, then there's more likelihood, particularly with acquisitions of assets, that you aren't dealing with an arm's length party, whereas the big funds are completely different. But where the general expense side of things gets caught is where from and I don't want to again harp on about any of this, where the fund sets up an administrative arm, which is a separate company wholly owned by the big fund, and that's where everyone gets employed, and then they just they don't really charge a market rate back to the fund for that, because all the profit would go, it's like a neutral impact, as an example. So I sort of understand why that general expense carve out applies, or doesn't apply. That general expense side of things doesn't apply to an APRA fund. But where we've landed on it is that 2 times, immaterial, not catastrophic, just like, so why even bother with it being there almost? So anyway, that's where that. So I don't disagree with you, because the $3 million cap is going to impact, 95% of the people impacted are self-managed super fund members. I've just made up that 95%, but I think it's probably not inaccurate.
I think the official figure was 80%.
Anyway, I can say 95.
Might have been, yeah.
There's a great quote, and I'm digressing here, from The Simpsons, where Homer Simpson says, did you know that 25 or 75% of statistics are made up? 25% of people know that. So anyway, that's where I've landed. I've used my Simpsons and Star Wars reference in today's podcast, so winning.
And footy as well.
And footy cricket. And cricket. Yeah. It is cricket season at the moment. So it's, that certainly is an area where that's come through. And the other thing, when ASIC brought out that the consideration of, if you've got less than 200,000 in super, you shouldn't have a self-managed super fund type thing. Again, paraphrasing, those cost comparisons, that a self-managed fund costs way more than a public fund. All of those sorts of things you see, where, I mean, there's obviously that not conflict, but the competitiveness between the big funds and the SMSFs, because they, we all operate under the same rules, but just differently. So I understand, where those different approaches. So with the NALI, back to that whole thing, I think that in this case, it isn't inappropriate for the big funds to be carved out of it. But if they're carved out of it on that general expenses, and like I said, where we've landed with the SMSFs on the 2 times, it just doesn't really make sense to have it there anymore, just because of materiality.
Yeah, I agree, Gemma. It disappoints me because that was probably one issue with the general expenses where if the whole sector gets behind it, it could actually be highlighted as to why the policy was not so sound.
Mm.
But then when you give one section favorable treatment and they say that, oh, well, buddy, you're on your own now. Oh, okay, off the hook. You're on your own now, buddy, which is exactly how we know it works. I just don't think that's helpful at all. And just another instance where I just, think that the policy decisions are questionable.
Yeah.
Can I say? Is probably a nice way to put it.
Yeah.
But look, I've had my little rant on that.
We all like our little rants every so often,
which I do feel strongly about. And to tell you the truth, I do want to say this, and I know that there's a theme to some of the editorials I write and some of the things I say on things like this podcast. But at the end of the day, I actually don't enjoy criticizing government policy the whole time. It's just that if it's bad, and we seem to have had a whole spate of bad policy for the SMSF sector in particular, it just needs to be called out. But, whether or not that will make a difference, I don't know. Anyway,
well, I think the policy side of things is a challenge. You can only lobby and, advocate and provide detail about, the implications, practical application, and, things like, well, back to the 3 million, total super balance opening, closing with adjustments. Is that fair and equitable, going, applying the objective of super, so how that all flows through. Anyway, it's going to be really interesting to see where we land on all of that. And again, we digress a little bit. So yeah, with the NALI stuff, definitely the asset specific expenses is the concern of mine, I have to say. Going forward. So, it might be an area where we do look at well, it's one of those things. Do you really want to put your hand up and bring it to the attention, of the commissioner if it hasn't been on their radar? I'm not a fan of head in the sand sort of things, but it's something that we just all need to be a bit more alive to, and perhaps we can resolve it as we go and bring it to the client's attention and educate clients more on how it works and follow on from that. But it's just something that I think people need to be more aware of and how that operates.
But the way these things work, I think raising your head is inevitable because somewhere along the line, someone's going to pick up on this. Well, we know that's going to happen, right? Once all of the other discussions died down, someone's going to pick up on this. So,
and I think there already is compliance activity from the at the tax office on it. So it's one of those areas that might increase. So we just need to be aware of it to try and head it off at the pass and mitigate any risks and adverse tax implications for our clients, I think. Yep.
But meaningful discussion sooner rather than later, I think would probably be a good approach. Yep. Anyway, I think we've had so much fun that we've run out of time again, Jemma.
Always.
That's possible.
Always.
So, look, I want to thank everybody for joining us today, and we hope you enjoyed hearing about this subject as much as Jemma and I obviously enjoyed talking about it. So, just wanted to say thank you again for being part of the podcast, Jemma, and hope to do it all again pretty soon.
Sounds great. Thanks very much, Darin, and look forward to chatting next time.
Sounds good. Thanks, everybody.